First of all, hello friend. This time around, instead of asking, I'll be doing a whole lot of giving. And my first gift to you is a manifestation. A manifestation that you're doing okay mentally. That your mental health is superb. If not, I manifest that it becomes better and it becomes superb. And the reason why I'm using the word manifest and not just merely using the word prayer is because a manifestation is attraction through action, attracting something through action. And praying about it is merely just asking for it. Get it? So, me manifesting for you to do mentally well means that, an attraction through action. It means there needs to be some form of action. And the action coming from my side is knowledge. Me teaching you and me showing you my knowledge and me sharing with you my knowledge. And on your end, the action that is to be taken is receiving it. Because receiving is also an action. When you receive something, it means you are taking the action of getting it. When you're given something, it's an action of giving. There's always an action. And the reason why I believe in manifestation, it's because we live in a world whereby there needs to be an exchange of value, a universal law. Whenever there's an exchange of value, that's when we mostly see rewards, because it's easy to pray about everything and do nothing about it. And you wonder why. You get nothing. You achieve nothing. You gain nothing. And the only way to gain and to see progress is to take the actionable step to displace yourself in a position of being able to receive. Nonetheless, my name is RomeoTshepisoSambo, and I'm a monetary education scholar that's been learning about, macroeconomics, monetary education, and all that for more than 10 years. I've invested in, displacing myself in a position to be able to know, understand, identify, and use trends and the knowledge that where the world is actually going, the knowledge that's new, knowledge that's old, past, present, to be able to predict the future. So anyway, nevertheless, all the information I'll be using today, actually most of it is from the St. Louis Fed. And the St. Louis Fed is the St. Louis Federal Reserve Economic Data Platform. You can go and check it out on fred.stlouis.org. This is just what's happening. It's something that's there, like it's in our faces. It's just that we don't consume knowledge the same way. There are very, very big problems. We live in a problematic era right now, in an era of problems. plenty problems, mostly formulated, through poor leadership from government, senseless printing of money, and the mere person who just does not have sufficient information on how to counter this needs to suffer and pay for everybody else that's doing it. Crazy, crazy, crazy. Anyway, let's start. Let's start. Let's start. Let's start. Let's start. Yeah, the first, piece of information. I'm not gonna try and make this long. I'm gonna try and make this, as short as possible, so I'm able to dish it out and to put it in a package that's not too trying to consume. However, I was looking through, some of my mentors' posts and some of my mentors' videos where he talks about gold and silver, and his name is Mike Maloney, and he basically is an economic, education scholar as well, and a monetary education teacher, meaning he teaches people about monetary education, which is the education of money. Because we are in a problematic era, but now to every problem there's an opportunity. And for you to be able to use problems as your great opportunities is to position yourself. And to position yourself, you need to be knowledgeable on the type of position you need to occupy. So this is me sharing information with you, and this is not financial knowledge. It's me sharing what I know and what I use, and you can just choose to do whatever you want to do with it. So right now, information gathered from the Fed, we can actually see here that this data of this graph, it was sourced from the Fed, and it actually represents the currency supply from, I think, 1913. I see 1970 here, all the way to present data, where we're at right now in 2023. So here, what we can see is the percentage in change from just even a year ago, like year to year, in currency supply. So meaning currency supply, in simple words, is basically the printing of more money and the devaluing of a currency. The consequence to that is, the devaluing of a currency, the crashing of a currency. So, and the consequent or reaction to the crash of a currency, or inflation, what we call it, or how they call it quantitative easing to make it sound difficult, is the rise in prices of stuff. And it gets to a point where prices rise so much that the normal person like you and me would be spending almost all the money they work for, if you work for money, on things like food, on just barely surviving. So here we can see, this is the graph which indicates how the government and how the Federal Reserve has been adding money, or quantitative easing, or inflating money into the world. So as you can see from here, in 1971, now from 1970, the reason why there's a dip here, 1971 was when President Nixon cut the dollar off the gold status. So it means that it was the end of backed money. It was the end where now the US was saying that, for this piece of slip, which is the US dollar, for this currency, for this note, which is no different to a dry cleaning slip or any type of slip, is a representation of the gold that we have in the reserves. So now that actually means that that representation was cut off. So now money or currency, how I'd like to call it, because there's a difference between money and currency. Money needs to have store value. It possesses everything that currency has, but money can last for long periods of time, meaning it has store value. So cutting currency of the gold status in 1971, as you can see now, the currency was crashing. The US dollar was crashing. So now what happened here is they said that the US dollar is not backed by any gold. So now every country, especially the US, can print money, recklessly. Like they print it out of nothing. It has no intrinsic value. Hence, we can see from 1971 here, there was a major addition of the currency supply. You see from 1971, you can see this peak, like it went from around 3% to just below 15%, around your 13th percentile. And as time went on, you can see that it was actually going down. It's going up and down, up and down, up and down. And in 1987, which should be around this period now, we started experiencing something called the Black Monday. And a Black Monday, actually, by definition, the term Black Monday is commonly used to refer to the stock market crash that occurred on October 19, 1987. On that day, stock markets around the world experienced a rapid and severe decline in stock prices, with the Dow Jones Industrial Average falling by more than 22% in a single day. The causes of the crash are complex and have been and have been subject to much analysis and debate. Some of these factors include concerns about rising interest rates, computerized trading algorithms, and the use of program trading strategies by institutional investors. The crash had a significant impact on the global economy and led to an increased scrutiny of financial markets. Despite the severity of the crash, however, the markets eventually recovered and continued to grow in the years followed. So that's what happened in 1971, and I predict in 1987. And I predict it happened again in 2001. The Nasdaq crash. It happened again in 2008 with the housing bubble. And right now, from the year 2023, going forward, we are about to actually see the everything bubble now, where it involves everything. It involves your Nasdaq, it involves your real estate, it involves a whole lot of factors, and I'll prove with information that I've gathered. And this is my educated opinion, if I may put it that way. As we can see here, in 2001, there was also, printing of more currency again, and we can see that it started crashing, and we can see this is a consequence from 2008. It went up to 10%, and then it just started crashing again. And then in 2019, COVID, they printed so much more money. Look at this, it's scary. So now all the currency that was in existence in just 2019, like the entire world, more than 26% was printed. Like more than 26% was added. Scary things, scary news. And the reason why I'm telling you that we are in a bubble, and I predict that we are in a bubble, and I'll show you with relevant examples that I've found throughout using my research, like throughout researching and using my knowledge, like past knowledge and past experiences. Okay. Yeah, now let's get to this. Let's look at the deposits. This is all commercial bank deposit. And this graph, like this graph was actually generated, with relative to the billions of dollars in the US that have been deposited. And it was also generated from the Fed, the Federal Reserve Economic Data by the St. Louis Department. So now, as we can see here, from the deposit in all the banks, like these are deposits, meaning that now the banks have money or currency. It means that money that's been, or currency that's been deposited into banks. We can see that, let's look at all the places. And for example, I talked about the 2001. So now you can see the 2001 by the NASDAQ crash. We can actually see that it went below zero, just about, if we estimate, we might say 10% or so. So, and they printed more money again. And we can also see here now, it's 2008. Again, this is when it crashed. And to bail everything out, meaning that now there were negative deposits in a bank, meaning that banks started to have bank runs. There was no currency that was deposited in the banks. So if you needed something from the bank, it was impossible for them to give it to you. If you needed your money or your currency that you actually held in the bank at this particular period, it basically just means that they were telling you that, hey, listen, we've been bankrupt, we've been liquidated. So we don't have your money anymore. Hardy, I'm sorry. We'll start again. So now we can actually even see here by 2019, look at this, the change in billions of dollars. It was about to crash, and then now look at they printed how much, like how much was added. And mind you, in history, never has there been more than 180 billion like worth of deposits in a bank. From here, in 2019 alone, the spiral, the money that was added into the economy, like the deposits, meaning the bailout, printing of more money, quantitative easing, resulted in the currency supply being at $900 billion. So now, 900 plus minus $900 billion was added more into the economy. And what happens when something like that actually, occurs? It means that now the prices of goods and services for the average person have to go up to account for the new existence of money or currency that's floating around. So to account for that, we can see now that people are like, okay, the people that are investors and everything, after 2019, prices of stuff got so much that now it started crashing. So as it started crashing, we can see here between the period 2019 to 2023, which is the current period. If we can zoom this thing properly, the graph almost hit minus 200% negative deposits in banks. And do you know what that means by negative deposits in banks? If there's a negative deposit in a bank, you start experiencing things like bank runs, which is what happened now. I think it happened to the Silicon Valley Bank, and it also happens to Credit Suisse, and it's starting to have a ripple effect on all the other banks. And I'll explain how that actually affects you. It affects in a very, very, catastrophic way. It affects mostly the middle class. It takes away the middle class. It forms, a binary society where there are rich people and there are poor people, and there are no people in between. And the middle class are usually the working class. To account for all of this quantitative easing, we pay in our taxes, meaning now you need prices of goods and services go up. You need to be working more to get what you would get the previous year. To account for all of that, they change how people, they change the price of stuff. They change the prices in a goodie basket. If you could get 1 kg of pap or rice or whatever, now you get 200 grams. And if you have a family, 200 grams is not enough. You need to go and work more to be able to get what you are getting, usually with the type of money for twice more. So now, if you're looking at this here as well, this is the S&P Case-Shiller. This is the graph for the National Home Price Index. And, this is what I'm going to be dwelling in mainly and showing people that there's a bubble and an everything bubble. It's crazy, guys. So now, looking at this, from let's call it 1980. I see 1990 here. We can see that a home was very, very affordable. It was still affordable. From the 2000s, after the NASDAQ crash, they tried to print more money because now people, like when they print more money, which is something called a bailout, it means that when they print more money, they print it so that they are able to borrow out people that lost everything, money, to rebuy things that they used to have. So now we can see that the home price was actually, going a bit down on this period. It went to about 5% more expensive than it should be. And we can see that now it started going up. So this is the compound annual rate of change in percentage. So now home prices and prices of properties, they have gone up now by 20%. So if you're a property investor and you actually, bought property in around 2004 and sold it just before, around end of 2005 to 2006, you would have made some money. Like in that year, your property would have increased by over 15%. So meaning if you had a property for $1 million, it would have been 1.15 million. Basically, 1,115,000. So now, from 2006 to 2007, we started seeing this. And we know what happened in the 2008, housing bubble. So now, what happened here now is, had you bought a house here for $1 million and, it was 20%. Look, the annual rate, the annual growth rate of a house would be at 20%. It means that if you bought a house between 2006 to 2008, this is what happened to the value of your home. So now, looking at it around 2008 heading on to 2009, we can see now that there was a negative annual change, like negative interest rate, meaning that if you had a house in that bubble, now your house would be worth less. A fair price is here by zero, where if there was no inflation, it would just stay constant. You understand? But due to inflation and quantitative easing, the graph kind of becomes like this. They can manipulate it in that way. And a house is regarded as an asset, mainly because, you can have a house for a long time and it keeps up to the value of inflation. So now looking at it here, we can see that it went to negative interest rates around negative 17%. So if we look at it, 17% to zero plus the 20% that's here equates to 37%. So had you bought a house worth $1 million in 2006, in just a year, under 2 years actually, or let's say 3 years, in just under 3 years, your house would have actually lost value, like around 37% of its value. And the people that know when this is happening and that understand this, people like myself, people like us, that understand this, know that to every problem there's an opportunity. Because when somebody makes a mess and the person that actually has a company that cleans up the mess actually benefits. So now looking at it from here, if you actually became creditworthy and you were great and you anticipated this bubble and you bought the house here, so meaning that a house that would be worth $1 million, the market value of it would be undervalued. And we counted it at 37%, just looking at it from a human eye. And 37%, it means that you're going to get it for 37% cheaper. Understand? So meaning you'd be able to buy a house that's worth $1 million with 630,000. You understand? And a year later, once it bounced back, when there was a bailout, just in this small period, it means that your house or your property that you bought there at negative interest rate is now, when it gets to zero here, it means that now it's back to $1 million. And then now when it goes over this to 3%, it means that, you've made a lot of money. So now looking at it like that, we can see that if you bought a house here and then now you sold it here, which was around, let's say, 2013. Say you bought a house in 2009 and you sold it back at 2013. It means you would have profited all of this growth. And going on, post 2012, 2013, we started seeing the house price go back down again. And when they do this, what does it mean? It basically just means that now the government printed more money to make things affordable again for everybody that lost things here, whose things were repossessed. They gave them a break by printing more money, and all the people that bought here made ridiculous amount of wealth, and people need to start over again. And as we can see, it's been like that. And then from 2019, we can start seeing a rapid jump. Like now, much more money was added into the into circulation, and we can see the ridiculous jump. Yeah. And now, looking at it here from 2023, where now, just in 2022, had you bought a house in 2019 and actually sold it in 2022, you would have profited a lot, from 3% to almost 30%. So it means that now between the 2021 period and 2022 period, it means that now housing prices actually rose up by 28%. And looking at it, we saw from the previous graph that plus minus 28% was added more into circulation, more money printed. So it accounted for that. Can you see a trend now? So for that, what happens now is that government or the Federal Reserve actually gets to a point where they cannot print more money because a currency would eventually topple. So what happens, to the price of goods and services and the growth rate of things all around? They expand, they become more, and this is what's happening now. We can see that now, currently in 2023, we are at negative 10% growth rate. So that you bought a house last year and you still have it and you want to sell it, you're going to have to sell it at negative 10% of the actual value of the house, plus interest if you took a loan from the bank. And it's still going down. Look at this. Look at what happens here now. So, and the reason why this is actually happening now, it's a matter of average. And if we're looking at average, the average, cost of something, because now in 2019, in the period between 2019 to 2023, people lost jobs. There was a lot of unemployment, and the government, yes, tried to print so much money to keep the economy afloat, but there's only so much that they can do. So people are in a period where now they are losing, they are losing money. They are losing houses. They are losing property due to not being able to pay the bond or installment. So now, when the majority of people start to lose something, the price of it goes down. Imagine now you're at your block or your street and 50% of the people lose their houses. It means that your house as well, the valuation of it, even though it's fully paid off, will go down. Hence, you started seeing a period between 2019 up until now that multimillionaires and billionaires have been selling their properties and, houses that they haven't fully paid off, or they're not willing to keep, or they're trying to, use the income or the profit that they would get from that house to position themselves to be able to buy it twice as much, 3 times, 10 times as much, when it gets down. And that's all just, due to knowledge and understanding. And I'll show you how I've been prepared, because to every problem, there's an opportunity. You just need to know how to position yourself. So going on to my emails, you can see here, your credit score is glowing. Oh my God. Upgrade to a top tier card. As you can see, a credit score means the ability to get credit. Right now, a lot of people are not being able to get credit. Why? Why is that so? Because they already committed themselves. They are already in debt. So now, everything that monetary education scholars and people that actually have money and that understand money have been doing from 2019, because they understood the effects it's going to have on most people. They've been selling themselves to become, they've been selling their stuff, their belongings, to become, credit worthy, or not to be in any debt, and have enough liquidity, have enough money, have enough backing to be able to be credit worthy for times like this, to be able to take, an opportunity of all of this problem. And I'll show you now. Let's look at it here. For example, let's look at the property prices first. I was just checking property prices here. Okay, yeah, let's go back. Let's take an example of the total loan amount, and then now say a loan is for a million bucks, and then we generated it at a 9% interest rate, and the loan term in months is 24 months, which equate to 20 years. Yeah. So now, calculating it, we will see that calculating it at a 9%, growth rate, 9% for 20 years times 9 is 180. So meaning, at this current growth rate, if I was to take a loan for $1 million and buy a house and pay it for 20 years, the bank, like what I would actually pay after 20 years would be 180% worth of what I actually borrowed. And mind you, this is not including any recession, any increase of percentage rates and whatnot. And you think that's going to happen in 20 years? It's going to be constant. My intelligent answer, no. But you can do your own research. However, after 20 years, when the house is fully paid off, I would have paid 1.8 million more, plus the million that I actually borrowed. So essentially 2.8 million rands. And imagine the valuation of the house after 20 years. If a house grows according to how much money is being printed, it means it would have grown in value, mad value. And I'll show you. So now, say for example, let's come back here. We are here by houses. If you look now, most houses are being sold, and you will see property agent companies are the ones selling them, and you'll be able to see that soon banks will be selling them. These are the people that know. You can see here. Yep. Red flag. Here's it. The bank is selling this, meaning that the house was repossessed. And you can do that in any state. You can see it happening all over the world. So right now, the people that were prepared and that know what's coming already listed, obviously, their properties to be sold. So now, once everybody, and let's look at this and make a South African example, actually. Now we are in the biggest, economic market crash or wealth transfer to those that are well positioned, like myself. And looking at it, when there's a lockdown or there's a shutdown of services, of people don't go to work. And when people don't go to work, money is not made. Businesses don't actually make money. And when businesses don't make money, what happens? People are laid off, meaning for people don't have jobs anymore, because the person that employed you cannot make any money, doesn't make any money, because you're sitting at home. There's no service. Correct? Good. So now when that happens, what effect do you think it's actually going to trigger? When people are sitting at home, businesses are not making money, it means that people won't be able to afford to eat at places they used to eat. Hence now, people at those places that are employed would now also lose their jobs because there's no service, like there's no money, there's no profit in. And businesses that have no insurance to stay afloat, which most don't, are going to die out. And when they die out, what happens when you don't pay your car or your house for 3 months? What happens? That, your property gets repossessed. Doesn't matter whether it's a 2 million rand house and you're owing 200,000. That 2 million house will be auctioned out for whatever difference you're owing, which is the 200,000. And then let's just make it 500,000. Yeah, to be realistic. So now, if I had a house and looking at a house, maybe that's valued now at 2 million. And the person took a loan and, you put yourself in so much debt and you bought it at the wrong time. And as you can see, like I showed you, it's going in negative interest rates. So now you owe 500,000 and you lost your job. And the bank sells the house that's worth 500,000. That's worth 2 million for 500,000, excuse me. Now, the people that are well positioned, that saw this problem coming and are prepared for the opportunity, can now go to the same bank that repossessed your house. So say now I borrow 1 million rand. And yes, at the end of 20 years, we calculated that if rates stay constant and everything like that, we'll be paying 2.8 million. So let's say now we put it at 500,000 for a bond. But the value of the house, mind you, is worth 2 million. So let's check for 500,000. Doing the same thing, 500,000, yes. When we calculate, let's calculate it again. So basically it means that now the interest rate and the monthly repayment rate that I am to pay if I borrowed 500,000 on a house, if I'm a working class, I would need now to pay 4,567 rand and 63 cents per month, plus the service fee of 69 bucks, which is around, let's just place it at 4,700 rands for this house. But now I took 1 million, I borrowed 1 million. So let's assume that it will double in value. So let's now say that's 4.7 times 2, right? So meaning I would have now to pay 9,400 rands per month for this house. So now I borrowed 1 million from the same bank that actually repossessed your house. And now I bought the house with their money that I borrowed for 500,000. I used 500,000 to develop the house, and the value of the house now goes to 3 million because they're looking at the overall value. It was 2 million. So say now after being refurbished and everything, it goes to 3 million, right? Cool. So let's do this. So the house is worth 3 million now, but I only borrowed 1 million. Do you know what that means? It means now I can sell the house to the same bank for 3 million rands. and for 3 million rands, and actually pay the million that I owe them plus how much? 9%. Yeah, pay the 1,090,000 that I owe them. So what's my profit from there? 3 million, right? It's around, let's put it at, yeah, it's 3 million. So we put it at 1.9 million profit that I would have made. And mind you, I haven't used my money. That's if I want to flip the house. But now I have a house that's worth 3 million. And if I have a house that's worth 3 million and I want to rent the house that's worth 3 million, how much would rent for a 3 million rand house be? If you're looking at it, let's assume rent for a 3 million rand house is 15,000. Now there's been a bailout. My house is worth 3 million. However, I've bought it with 500,000 and refurbished it. So now for 500,000, we calculated that I would need to pay 4,700 times 2 because we borrowed twice the amount. So now, which means it's a 9.4, like we will need to pay 9,400. So assuming the rent for that house is 17,000. So now the same person that lost the house will be paying 17,000, right? Minus the 9,400 for rent after they get a new job and they are stable. So now we're making 7,600 off of that house that we didn't use our money to actually pay for, to buy. And we don't use our money to pay for the bond, but we still make a nice profit of 7,600 per month. And now you can scale that. Imagine now if you have 10 houses, it's 76,000, which is a good salary. But again, 76,000 from plus 10 houses, assuming you have 10 now. So by the end of 20 years, you would have fully paid off, or whatever years, depending on how fast you want to pay it off, you would have fully paid off the loan without using any of your money and gaining a profit from that. And after 20 years, those 10 houses, how much do you think they would be? Get it? So now looking at it, we can see these houses, all of these, they're gonna fall, as we can see. And as they fall, now, this is where this comes in. Your credit score is glorious. It's immaculate. Looking at it, I was just checking at mine. So it's almost the perfect credit score, and I can qualify for almost everything, like every card, even credit cards. You can see advertising, discovery, the black ones, and the ones that you don't see here means actually just means that I have the banks and I'm already using it to do that. And I was shocked because I also saw, American Express, and you can see that there's a higher chance of success here because they want people to take credit because the banks are in, if you take credit, it basically means you allow them to print more money. So credit, if you take credit, they add interest. And how is the interest added? Where will you get the interest? It's formulated. You need to borrow from them again to be able to pay the interest. Crazy, right? However, looking at it, if you look at physical businesses, look at like things like game, there's a lower chance of actually being, getting the credit card for there. And Builders Warehouse, Macro, and you should start seeing, there will start being things like, businesses will be burning. Like something is just going to happen because now they have insurance. And instead of laying people out, cleaning yourself out, you can still claim that from insurance. You are insured. It means that being insured about something basically means you shorted the possibility of a loss on it. So now, once they've insured their businesses, they're going to make more money. But who's going to lose? The people that are there, the working class. And to actually prove this again, to get to my point and actually conclude it, let's look at the gold price. Because we can see, if you're looking at it, from 1971, we can see the gold price, what happened to it. When the dollar was cut off the gold status, there was senseless printing of money, it started falling. And then we can see what happens again. It starts rising to account for, all that senselessness, that printing of money, because there was a law that was signed in 1971 to be like, okay, America, like they said, okay, the Constitution says the American dollar is not backed by gold or any other currency, because other currencies were backed by the American dollar and they existed due to the American dollar. Whenever a currency topples, gold will account for that price. Gold and silver will account for that. That is why gold is called God's money, because it's finite. And if something is finite, when you cannot make any more, any less of it, it means it keeps up to value. So it's God's money. Gold that was there 5,000 years is still there today, just in another form. So as we can see here, this is what happened. And then looking at it again, we can see now here after the 1987, the Black Monday, we started seeing the gold price also go up. And, quantitative easing and bailouts were made, going down again. Let's take it fast forward. 2001, bubble, the NASDAQ bubble. What started happening to the price of gold? Started going up. And then, mind you, every time it reaches a lower low, it's another high. It's the highest price it would have been. Once they print more money, it keeps on doing that. It kicks currency's ass all the time, 100%. It has done that in history for many years, thousands of years, through different civilizations. It always ends the same way. So now we can see here in 2008, it reached the all-time high. And what happened? There was a housing bubble. Hence, it was like that. So now they printed so much more money as a bailout. So now it accounted for that. Obviously, there was an increasing currency supply. So now it went down. But now whenever there's an increase in currency supply, goods and services go up, there's inflation. So, and gold always accounts for that. So now we start seeing from 2008, it goes up. 2012, there was another recession. When they printed money, came down. 2016, recession, yeah. So it set the lower low, the lowest low. And then from 2016, now it started going up until 2009, 2000, and as we can see in 2019, while it was here, there was obviously senseless printing of money, which manipulated the price. And you can see this little drop here. But from there, look at what happened from 2019. Shoo. I mean, guys, this is a monthly graph. Look at the rate of growth. It has been growing all these years, and this ridiculous jump here. So 2020, as we can see, it had reached the all-time high, where now an ounce of gold was over $2,000. Actually went to $2,070, if I'm not mistaken. I traded this. It went down again, 2021, accounting for, because people was printing more and more money. We were still in COVID. There was senseless printing of money. Like I showed you that period between 2019 to 2021. More money in circulation has been added, more than ever. So now, as we can see, 2022, it went up to account for all of that. And more money was still being printed. They tried to debase it down. And now we are here by 2023, and we start seeing it go up to actually form what? An all-time high. So what happens whenever you start seeing gold rapidly going up? It means there's a bubble. There's something wrong. 2001, swing. Right? 2008, swing. Right? 2016, swing. There we go. And now here it's an everything bubble. Something that's so catastrophic, that's worse than anything we've ever went through. And the government can't print more money to save it. So, that's what we anticipated to do. That's what I'm saying. To every problem, there's an opportunity. And you just need to know how to position yourself. And, positioning yourself means you being on the other side of the problem. Being the guy that cleans up and taking that opportunity. Positioning yourself to be opportunistic about world problems. So now, once you start knowing how this operates, you can prepare for it. You can anticipate it. You know when is a good time to buy and when is a good time to sell stuff. Hence, right now, if you've noticed, every wealthy person, and not rich, wealthy, they've just been making sure that, they're investing in liquid assets. They have a lot of liquidity. They have no debt. I can make an example. I won't say who, but somebody was found, the president of a certain country. Who's a president of a national party which has alphabets A, B, C. I won't say who. He was found with how much in his house through a robbery. Is that starting to make sense now? Look around you. Look at all the wealthy people. And I mean people that are wealthy and people that know about this stuff. Tell me if they've been buying stuff or selling stuff. It was a pleasure. And again, looking at crypto, if you look at it look at the 2012 perspective, we see, look at the similarity. When 2017, like around November, December, all-time high, gold, 2017, where are you? November, December, where are you? 2017. Yeah, November, December, 2017, gold was at a high. Let's do this again. Let's look at another high period. 2021, April, and then we look at 2021, November, December, looking at gold. 2021, around April, March, yeah. correct? And then 2021, looking again, November, December. I hope y'all can see this. And what happened in 2022? And now we are in 2023. You can see this. 2022 and 2023, we can see this. I won't say I'm a wizard, but I can kind of like see what's happening. And, you know, you just need to know how to position yourself to be able to use all of this as your big opportunity by investing in things that are going to be solving these type of problems. For example, in 2019, there was COVID, but what happened to the people that invested in sanitation, like in sanitizers, in PPEs, in masks? Did you ever thought that you would be broke as a doctor and overworked, and the person selling sanitizers would make much more money than you ever did in your whole entire life in just a year, without any degree, nothing, no knowledge? So do you get why I'm saying to every problem there's an opportunity? You just need to know how to position yourself. And positioning yourself means identifying patterns and looking at patterns, looking at the direction where the world is going, and using and investing in solutions and, you know, things that are being formed as the world transitions. For example, from 2001 to 2008, it was very easy to get like a job. You could just go. And before that, you know, you could get a job without any skills, like manual labor, because there was not a lot of technology. From 2001, 2008, after the bubble, they required people now to be like, hey, we need skilled labor. So you need to be from university. From that, like when you were from university, you automatically had a job. And what most people don't understand is that it only takes 4 to 5 years, 3 to 5 years actually, to get a degree and be competent at something. So if there were nurses, a shortage of 1 million nurses from 2008, and, you know, 1 million registrations were there, 1 million people got jobs. So that market is nucleated. Now there needs to be new stuff. From 2012, the nurses that graduated now around 2016, some of them got jobs, some of them that didn't, like, it was very shaky. Now from 2016, if you now had skills, you know, that were obsolete, because now we used to say we're an age of information. Now there's too much information out there and there's an overabundance in the market. The market is nucleated. We have too many nurses, too many doctors, too many teachers, too much of every flipping thing. So, you know, art gets value from scarcity, demand and supply. Where there's less of a supply, there is always more demand. And when there's more demand, the price of that thing goes up. Look at how much people were buying alcohol in lockdown. You know your source. So now, to every problem, there's an opportunity. So now imagine, from 2016 up until this current period where we're in, if you had a digital skill and, you know, you were very, very good digitally, we saw a lot of entrepreneurs, you know, that practice your Forex trading, that practice, you know, your drop shipping, drop servicing, online marketing, everything that had to do with the internet, because you can take information from the internet and literally create an entire job and make a person obsolete. They made a lot of money. Up until now, it's becoming nucleated. And now, what is the new industry that we're seeing? We're looking at AI, artificial intelligence. It's a new technology. So we can see now, everybody that invests their time in that and, you know, honing such a skill they're going to benefit greatly, because now you are able to make, you are able to create jobs, or you are able to make yourself an income through using those skills. I mean, now when you get to McDonald's and there's been a recession and everything, when people are being laid out and you want your business to still stay afloat, what happens? Entrepreneurs like me that invested in honing their skills, program, computers that don't need people to be there physically employed, to be like, can I take your order, please? No. You just get there, you press a button, you press a computer, and you pay. And imagine, through an invention of such a tool or such a computer, how many people are left without jobs? Imagine cashiers now. After every recession or every problem, they become new job opportunities. So you just need to know where it is. And to know more things like this, follow me, RomeoTshepisoSambo on Facebook, Romeo_Tshepi96 on Instagram, and my business as well, at 72 Degrees Ltd on both Facebook and Instagram. On Twitter, I am at Sambo Tshepiso. Peace, love, and light from yours truly, the monetary education scholar. I hope that you have a thoughtful day and you absorb this. And information is obsolete if you do not apply it. I can only give it to you. What you do with it is all up to you. And of course, if you want to dive deeper into things like this with me and, have me teach you everything I do and, avail my time to you, of course, my stuff ain't free. Ain't no free. However, there are information. There is type of information where I put out through my Money Mondays show on Pitch Radio. I work on radio as well, and all my digital platforms. These are pointers or indicators. This is an indicator for me to show you how to take this big problem and an opportunity and yield yourself. I sell those type of services because I invested hundreds and thousands of dollars into knowing what I know and honing my skills for over 10 years to give them away for free. So yeah, talk to your boy. Otherwise, peace, love, and light. It's too much heat for the boys to handle. Let's do it again next time, maybe. Stay awesome, friend.